Imagine logging into your corporate treasury account and seeing billions of dollars disappearing from your balance sheet in a matter of months. Most executives would freeze, the board would panic, and the standard playbook dictates that you sell everything to stop the bleeding. Instead, one CEO took on billions in new debt to buy even more of the asset that was crashing. That executive was Michael Saylor. His decision to leverage his software company to accumulate digital assets has become one of the most heavily debated financial strategies in modern Wall Street history, which raises a critical question. Are we watching a reckless gamble play out in real time, or is this a calculated display of conviction that others simply don't see yet? Long before cryptocurrency, Saylor built and ran a highly successful enterprise software company. He spent decades navigating market cycles, tech bubbles, and deep economic downturns. Through all of that, he identified a quiet, persistent threat to his company's success. When you hold massive amounts of cash in a corporate reserve, inflation slowly steals your purchasing power. If your bank yields 2% interest, but inflation is running at 6%, your company is actively getting poorer every year. So where do you park billions of dollars for 20 years? Physical assets like gold are expensive to store and move. Real estate is highly illiquid, and broad stock portfolios carry their own significant market risks. To preserve wealth over decades, Saylor realized a traditional treasury strategy wouldn't work. He needed a different mechanism to store value. After months of analyzing the landscape, he directed his company's capital toward an unorthodox solution: Bitcoin. His reasoning came down to simple mechanics. Central banks can expand the money supply to stimulate economies, which directly dilutes the value of every existing dollar. Bitcoin operates on a strict, mathematically enforced code. There will only ever be 21 million coins. No government, executive board, or central bank has the authority to issue more. Acting on this data, Saylor began converting his company's cash reserves directly into Bitcoin, eventually deploying billions of dollars into the network. The traditional finance sector reacted with intense skepticism. Analysts issued warnings, commentators mocked the strategy on television, and many investors concluded the company had lost its bearings. For Saylor, engineered scarcity served as a mathematical shield against the certainty of currency debasement. This chart shows the severity of the ultimate stress test. When the broader financial markets contracted, Bitcoin's price plummeted, and billions of dollars in paper value evaporated from the company's balance sheet. The media cycles were brutal. Pundits and shareholders demanded the company cut its losses, abandon the digital asset experiment, and return to traditional cash management. Saylor's response shocked them again. He didn't sell a single coin. In fact, he found ways to acquire even more. This chart shows the erratic, day-to-day price swings of the asset. To Saylor, these temporary fluctuations were irrelevant. A 20-year macroeconomic thesis on global money printing is not invalidated by a few months of negative price action. Financial conviction is relatively easy to claim during a bull market. It is proven in the depths of a crash, when an investor refuses to let short-term fear override their long-term data. Gradually, the institutional landscape began to move. Major legacy investment firms started filing for Bitcoin products and exploring digital asset services for clients. An asset that had spent years relegated to internet forums and tech blogs was suddenly appearing on the agenda in corporate boardrooms. The debate over its ultimate viability is far from over. However, the core conversation has shifted. Bitcoin is now evaluated as a potential long-term corporate treasury reserve. Saylor's stubborn persistence provided a high-profile case study for institutional observers, making it difficult for the legacy financial world to ignore the strategy. Mainstream interest does not erase the very real hazards. Bitcoin experiences violent price swings, sudden market panics, and future regulatory actions remain unknown. Blindly copying a billionaire's corporate strategy without understanding your own financial timeline, risk tolerance, and goals is dangerous. Successful investors balance the pursuit of returns with rigorous risk management, ensuring they can survive the inevitable downturns. And the final outcome of Saylor's massive corporate bet is still years, maybe decades, away from being settled. Great investors build their conviction through research and patience, ignoring the daily headlines to focus on the underlying math. If you enjoy deep dives into money, investing, and market psychology, and the stories shaping our financial future? Subscribe now. We release new financial documentaries every week.